Hey, Tilda Muschetti, Altitude Syndication Founders Club. During yesterday's really great rapid implementation call, where we go through and get our members syndicating, we talked about a topic that's been bugging me for a while. And so I wanted to put this out not only to our members, again, but also to the real estate brokerage community, because it's something that I think is fundamental, that gets missed and gets overlooked. And I think it would really kind of raise the bar for the whole industry. So what I'm talking about, and I'm going to share my whiteboard here, we're putting things together with an eye at first on the now. It is a snapshot. So this snapshot is a current basis in time of where the property is and all the financials and how it adds up from there. So under the now is a bucket of stuff. And these are all the things that you do and gather up in order to put into your financial analysis. And in this bucket is facts. And facts are huge, right? We want to know exactly who the existing tenants are, what their leases say, what the property expenses are. Those sort of things are facts. The things that are not facts but go into that snapshot are assumptions. And I write assumptions small there to emphasize the point that in the now snapshot, in this time zero, we are trying to say these are the facts. There are little assumptions that we still need to make because we still like to assess some sort of idea of what the credit risk of a particular tenant may be. Or we want to say, well, we think that property taxes is going to be this going forward for in the next bill, or that some catastrophe is not going to happen, or things like that. So facts is huge, assumptions is much, much smaller. But we also are doing, when we're doing a pro forma, or we're doing projections, we are looking at the future. And in this future, there is also a large bucket of items that we're gathering up here. And here, we still absolutely have our facts. We have facts as it relates to the property size that are still consistent. We have facts that this is the management company that's probably there. But we also have in big letters, and I'm going to try and fit it in here, is our assumptions. And as we get further and further down the line of these, from the now to the future that we're doing, whether it's a 5-year projection, a 10-year projection, whatever, as we get further down to the now, to the future, we make more and more assumptions, and our assumptions get bigger and bigger. And those assumptions also have a characteristic. And so that characteristic is really, can be thought of as two different things. We've got optimistic, and we've got this idea of conservative. And I'm not making a political statement here. I'm just pointing out the fact that we tend to call that conservative and we call the other optimistic. So, conservative versus optimistic. So we may decide, okay, we think rent growth is going to take place at 3% for the next 10 years. That's fairly optimistic. We may say that the cost of operating expenses is going to grow at 3% a year. That's a little bit more conservative. I tend to use 2%, so which is a little bit more optimistic. We tend to use CPI pegged at 2% rather than 3% most of the time. It's just, those are the standards. But it's on this scale of, that is a bell curve between conservative and optimistic. And as you go further and further down this timeline from facts, from the now into the future, those assumptions that you make are going to fall somewhere on here. Now, most of your OMs are going to be here. They're going to be fairly optimistic, but you're not going to want to put them way out here so that it's so optimistic that anybody who looks at it is going to throw it in the trash. But you also aren't going to put it in a very pessimistic mode, because that's just going to defeat the whole purpose of why you're putting it together in the first place. So we tend to put it there. Now, most of your institutional investors, they tend to look at it somewhere here in a realistic but conservative mode of what those projections are. And that's why when they come and they ask for your financials and they tend to throw out your pro formas, it's because you are too far on the optimistic side, and they know that going in. And they have their own baseline set for what they like to see for analyzing any particular deal. So I hope this helps looking at this through this lens of going from facts being really big to facts really small, and assumptions really small to assumptions really big, and then going through this process, this bell curve of looking at and thinking about, well, how optimistic versus conservative are my assumptions? Because you need to know where they are too. So, because they all are kind of true, but we're really basing it on probabilities. And so the more you can convey the probability and support why you think that's your optimistic probability is correct, the more likely your pro forma will be accepted as more valid or closer to what is probably going to happen than not. So again, this is Tilden Moschetti, Altitude Syndication Founders Club, 3, 2, 1, liftoff.